Good. All right, so we are currently looking at SOFI technologies on the weekly, and this is a beautiful, beautiful, beautiful chart by one of the students. Love this really bad. So I just got a great explanation of what we were looking at here on these charts, and I just kind of wanted to like go through it and then go through looking at mine as well for how we want. And so this video will help show how to bridge the gap between charting it, analyzing future moves, and then what to do when price is at our level, how we enter, exit, and from there. So here on SoFi, I mean, it's just beautiful. The fair value gaps are all marked off. We understand what phase of the market that we're in, that here at the top, the market was in when it was consolidating at highs here, that this was the distribution phase. After the distribution phase and we break out of the range, we expect to see a drop. And that's what we see. And where would we expect for price to drop? We would expect for it to drop to a demand zone, to a bullish magnet, to a bullish liquidity area, whichever terminology you like to use. We expect for it to drop to lows where the market previously told us that there's liquidity there and they like to do some action. So on this chart, what I do is when I'm charting, I always want to know like where the next magnet is above and below me. So if I'm knowing that this is the distribution phase at the top and that after the distribution phase you're going to drop, I want to know where is a magnet below. Where would that be at? So in this case, I would go to the I mean, you can use the weekly chart, of course, right? But I would go up a time frame to make sure that I saw where that was. So if we go up a time frame and now I'm on the monthly chart, it's just we have this well, it's a bullish fair value gap, so this should be green. But we have a bullish fair value gap, and that's what we are trading below today. Well, I think this is the first time it came below it today. Yeah, it is because it held it last week. So we see we got that clean break below it today. Now, mind you, I did go through and I made sure that I set these levels based off like the exact high and low. So we see the high of this monthly candle was 1892. So when we look at my ooh, 1892. And then the low of the third candle is 2060. Okay, back. So those are exact. Okay, boom. So the low of it here at this 1892. I think the alert didn't even get to go off because it didn't even tap 1892 today. It just got below it. But okay, bet. So now it's like, well, okay, now what, coach? Because we've run through the monthly fair value gap. What am I looking for now? Well, babes, we see another fair value gap below there. We see another one right below here. They were stacked on top of each other. Now, before I even map this, well, we'll have this mapped out here. The reason why this is the first one, the bottom one is the first one. The top one that we've just traded through is the second one. This is one because it was created first. Two, the one on top, created second. All right, bet. Since we've traded through this monthly fair value gap, now it's like, oh, well, shoot, we coming on down to this next monthly fair value gap that's below here, especially if we trade into it. So knowing where price is going to go, that's the first step. But what I wanted to say is why I was paying attention to this second fair value gap is because that was the closest to me, right? It was the closest to me. But why it was the most important to me is because this one was created when price changed structure, right? This was a bullish continuation right here on the monthly. When we got this close above with this candle here, when we got this close above the previous monthly high, which this candle closed above this previous high right here, right? This fair value gap was formed, oops, when price shifted structure. In this case, it was a break of structure, all right? So I know that this was important. Y'all created a magnet as we had a market structure shift, a shift in structure, I'll say. All right, bet. But again, we have this one below us, and let's go ahead and tighten up the coordinates. So the high from the first candle is 1478, and the low from the third candle is 1735. All right, bet. So this 1735, the next place that I need to put an alert, well, I really need to have an alert at both of these places. The bottom of this monthly fair value gap we just traded below, and then at the top of this fair value gap that, is like, okay, well, if we're going to continue to be bearish, this is where that bearish continuation would be. Wait, so this low was 1735. Let me put this here. Wait, why is my thing? If this low was 1735. Oh, my coordinates were all the way off. And then this high is 1478. Okay. All right, there we go. So that's 1735. Now, if on the lower time frame, if this, so this right here is just straight up the range. This is straight up the range I'm paying attention to right now. 1735 to 1893. Automatically, if this is below if this closes below 1735, I'm getting into puts and I'm trading it down. I'm trading to the mitigation level and then the bottom of the fair value gap. Those would be my targets. It would be 1735, an entry below 1735 with a target of 1607. So we're gonna say take profit one, and then the bottom of the 1480, the 1478. Well, we're gonna say 1480. This would be take profit two. All right. Now, if my entry is below 1735, because I'm just running the gambit of this next monthly fair value gap below, and let's make sure we put that in there. Right. So I'm running the gambit of this, then my stop loss is 1730 if it closes outside of 1735 immediately. So I want to add this in here because let's say that by the time you look at it, price is at 1675. And it's like, well, it's below 1735. Is it, can I get in? Yeah. And there's several ways to look at it. One, the person that I'm speaking to right now, and honestly, this is for anybody watching this. If I'm on the monthly time frame and I'm setting my analysis, the monthly and the weekly time frame and all of that, and I'm seeing these moves that are taking, this is a swing trade. I might not enter right at 1735. It does not knock me out. Can you choose to go down to the lower time frame to go to the 15-minute and you want to make sure that everything is bearish in there? Yes. Can you also choose to remember that this is a swing trade? You're going to buy time on the contract, which then offers you protection so that you can leave your stop loss at a close out of 1735? Yes. You have to remember that you're not day trading. You're not buying a weekly contract. And also you have to remember that you only need the contract or you only desire for the contract to stay green the entire trade when you're doing a day trade. When you're swing trading, things happen day to day. So my analogy that I like to use is, let's say that it's a Saturday and I call you and I ask you, hey, how was your week? Mind you, at some point on Tuesday, somebody cut you off and made you late for work. And when they cut you off, they was honking their horn at you and flipping you the middle finger. And you get so heated. You go into work and you just heated. You thinking about that. By Tuesday afternoon, they call you into the office. HR does, and you go in there, you're terrified, and they tell you, we love what you've been doing. We've really been watching you. We want to promote you, and this promotion comes not just in title, but you're also going to get a pay raise. Then you go home, it's the next day on Wednesday night, you get your report cards from the kiddos, and they're all on the AB honor roll with perfect attendance. And then on maybe on Thursday morning, you go into work and someone just look at you sideways, and you're like, who the heck do they think they are? But then on Friday morning, they come in and they tell you, you know what, we tripping. I don't even know why we made you manager. You need to be the regional manager of all of this. Here's your pay raise, where you want to live. You can do anything you want to do. When I call you on Saturday and ask you how was your week, you're not gonna, the first thing out of your mouth is not gonna be somebody cut me off and flip me off on Tuesday. You're gonna the only thing in your mind is the whole week that you got pay raise after pay raise and the kids are all doing good and you just congratulating yourself. You're not worried about that little bitty moment that happened on Tuesday and somebody looking at you sideways on Thursday. You're looking at the big picture. That is the exact same thing with swing trading. It's the big picture. There's going to be moments where somebody cuts you off and makes in traffic and makes you a little bit late to work. But does your job care when they looking at the big picture of your performance? No, they're going to give you a pay raise. Hopefully that make analogy makes sense to y'all, to everyone like listening to this. Yeah, you can drop down to the 15 minute if you want to, but you're swing trading. You need to be up here. As long as this is below 1735, you're staying in to trade it down to 1480. If it closes back outside of 1735, you exit the trade. It was a risk that you took. We take risks, we take calculated risks, and that's that. The beauty of it is, again, you're swing trading. At this point, today is February 23rd. Something like SOFI, we could get a March 20th expiration date and just call it a beautiful thing, right? We have no problems. That's a beautiful, beautiful thing. You're gonna have time. So if you were to enter at 1650, because that's the time that, that's where price was by the time you got to the chart, by the time you saw the alert. If it does go against you and it closes above 1735, with you buying 3 or 4 weeks out, are you going to be down? Yeah, price went against you. Yes, you are. Are you going to have lost 80%? No, you might be down 20%. Maybe. It The way we need to look at it is you took back 80, or you were able to keep 80% of your capital. You retained 80% of your capital. You didn't take a 20% loss. You retained 80% of your capital because you had a plan. The plan was, this is a magnet on a high time frame, and we're going to scale out in pieces of it from the top of the magnet, in this case, the fair value gap, the mitigation level, and the bottom. All right. So boom. Now let's say that this doesn't go against us. This is in our favor. We entered because the alert was below 1735. We come and we bought 5 contracts. It gets to the mitigation level here at this 1607. We exit, or we want to go ahead and sell 3 of the 5 contracts. Why? Because this way, even if price, let's say that it gets here and decides that it wants to hold here and it comes back up and it's at the 1735 and you're like, okay, I'm going to get out. This is just an example. And you're like, okay, I'm going to get out. You overall, you still make profit because you sold a majority of your position in profit, right? The 2 runners, it's okay. They might be red, but you still walking away green in profit overall. Bet. So at your first target, always scale out the majority of your position. If you only bought one, take profit. It is what it is. All right. So do that. But let's say instead of doing that, it ends up breaking below 1607. You look at it, we still sold 3 right here, right? And it keeps going. Now, where's your stop loss? Because price is below the first take profit. Your stop loss is now moved to where you took profit, the first place you took profit, right? If price comes below, take profit 1. So this 1607. We would never let our contracts still be on our contracts if price came back above here, right? Move that stop loss to 1607 because now you know for sure, even if this pulls back, right, to above here, you exited in profit because again, you entered somewhere in this first quadrant. right? So don't let it pop back up in the second quadrant. So we do that. So it gets, to here. And then we'll say we get to this last take profit. You need to not care what happens after this because this is the plan that you trade. This is the plan that you mapped out. You got to get used to, oh, it hit my take profit too. Let me get out. Is what it is. And then what do we look at from there? Well, I definitely suggest once it hits your final target that you take a break from it, step back for a sec, congratulate yourself, do all of that. And at that point, shoot, we looking to see, okay, well, what's popping next at that point? Okay. So let's say that this does trade below this month, the first monthly fair value gap here. We below 1480 now. Child, at that point, I'm looking like, well, where the heck you want to stop at? You know? I mean, we have an order block here. I'd say, okay, well, maybe we're gonna run to the bottom of this order block, but I would doubt that. It ain't no way. You know, I do think that this is gonna stop somewhere inside of this first monthly, the one on the bottom, the first monthly fair value gap, the first one created. I do think it's gonna stop somewhere in here, and that's me defaulting back to fundamentals because it's SoFi. It's SoFi. This just needed a good rebalance because it literally ran from $8 to $32 in less than a year. It just needed a good rebalance. And if we're gonna talk market structure, right? We had a higher high. Well, I don't even, let me do it. I'll do it. I'll color it. We had this higher high that dropped and made this higher low that popped all the way up here, made this higher high. All this would do is as long as we stay above this previous higher low, I know that was a, let me try and draw it correctly. As long as we stay above this previous higher low, this sucker bullish, right? So I would assume based off the fundamentals, it's going to create the higher low somewhere at this monthly fair value gap and then give us the move back up. That's what I'm anticipating. All right. Now, I want to go back since we have this in mind. And let's go back to this beautiful chart that was analyzed and finish this out because that was our downside plan for this. Wait, and so we talked about what happens below this, the monthly fair value gap. So let's talk about because we're in this range at this 1892. What would we do if price broke back inside of, or if price closed back above this monthly fair value gap? Keep in mind, this is a bullish monthly fair value gap. The sucker might have just came down and tapped this and only needed to tap the top of this fair value gap to pick these orders up. Because it is also an order block there too, right? We see these last opposite colored candles. It might have just, that might have been all it needed was just to tap this right here and call it a day, right? I'm not Miss Cleo, and neither are you that's watching this and listening. All we can do is just see what's below, or I'll just say ahead of us, whether below or above, right? And then react off of what happens when it gets there. So if this was to pop back inside of this bullish fair value gap, hey, this was the higher low. Let's rock this out. And what would I do? I would run the gambit of this monthly fair value gap. A close inside, a close above 1893. The same way we looked at this monthly fair value gap down here and broke it into three pieces. The bottom, the mitigation, the top, same thing. A close above 1893, the target is 1977, from 1977 to 2061. With using the same levels as my targets, where I would scale out and where I would adjust my stop loss as well. Okay. So would I make a move as a swing trader? That's what this video is. This analysis is a swing trader. Would I make a move in between 1890, in between these two fair value gaps? Hell no. 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 Eventually you're gonna close above here or close below there. I'll take that. We have two very neat trades right here in front of us. Love it. Now, I want to go back to this gorgeous, gorgeous chart. this person had this all written down, wrote down. Now, up here above, they have the 3-month open and the 3-month close also marked off. So that lets me know that they're interested in playing the long game on this chart. So let me make sure that I include that into my analysis. I'm going to go to the 3-month chart. And again, they had marked off the previous quarterly chart. That's where they got the open and the close from. It was here at the top. So since we already went below, especially the low of the previous quarter, right? Since we got below there, here I do have it marked as a weekly reversal, which it was a weekly reversal to the upside, because we see this was the previous low. They also, annotated that, hey, this was a bearish change of character. After a bearish change of character, what I'm looking for is a lower high, if it is indeed going to be bearish. Look how this monthly fair value gap gives me the second one gives me a good indication of where that could potentially be. Because again, this was right here was the bearish change of character. If it's going to continue to be bearish, it's going to make this low, pop up and give us a lower high. We have a bullish fair value gap, a bullish order block from the monthly right here that is showing us where that could indeed happen. Now, the beautiful part about it too is that this monthly fair value gap, it actually coincides with this weekly fair value gap right here as well. I know that this third candle kind of it dips into it a little bit, but it's a weekly fair value gap was created right there. Sexy, 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 sexy. Okay, bet. Would very much so expect to see that this would pop up, because this is a pretty decent drop from 23.42 down to 17.30 something. I'll just say this was a 17.50, whatever. This was a very beautiful drop. Again, it came to this magnet. I would expect to see that this would start to pull back up now. I wouldn't be surprised if my alert went off that this closed above 18.93. I also wouldn't be surprised if my alert went off that this closed below 17.35. And it went ahead and ran down here and went ahead and, did this and then gave us the push to the upside. I'm not Miss Cleo. We don't know. All we can do is be prepared, watch, and react. All right. Okay, so boom. Now if we get a close, if price goes heads and and it pops up here and then it closes outside of this bullish monthly fair value gap, my bias is that, oh, this isn't going to create a lower high. This is going to go ahead and run the highs. This is going to go ahead and run on up. That would be my bias. If we go ahead and get a bullish close outside of this bullish monthly fair value gap, it'd be like, all right, bet. But rejecting anywhere inside of this bullish monthly fair value gap would have me thinking, ooh, okay, lower high. We're gonna get that lower high come in and go ahead and run down to the first monthly fair value gap. Bet. But going back to the 3-month, wanted to add that in, since it already lost the previous quarter, right? We can still use the same levels from other 3-month charts. So this 3-month chart, we already have this low marked off because it coincides with this monthly fair value gap. The low was 17.35, right? Coincides with that. So it's like, dang. Also, we want to do the open of this, which was $18 even. $18 even. This candle opened at $18 even. We're going to let's put something right here. We'll do this and we'll say this was Q2 open. Was this quarter two? January, yeah, the quarter two open. Let's put it right at 18. Because that was the open, right? Was that the exact open? Yeah, 18. And we're going to drop down to the daily. Let's look at okay. So we see that we're getting this bounce right here at this 18. Is this necessary to do what I'm about to do? No, but I'm just curious to see how price reacted on the 5-minute right at that 18, right at that quarter two open. Let's see. What's the opening candle today? This was the opening candle today. Oop, nope. Opening candle today right here from 1875. It hunted down this 18. Looks like it's creating a lower high here on the internal time frame. Like, right, we had this high, well, a high here, then it created a lower low, and it looks like this is creating a lower high from here. Interesting. But we're gonna take our butts back up here to the weekly. And all that does, honestly, is just tell me like on this lower time frame, oh hey, if this holds 18, then yes, highly probable it's gonna go ahead and this is where it's gonna make this high, whether it's a lower high or it invalidates, it's gonna make a lower high, whatever it is. But below this 18, since this is such a high probable level or a highly liquid level, because it's a 3-month level, right? Trades were placed here all quarter for an entire quarter. Below 18, a close below there is like, oh, okay, yeah, you finna go ahead and hunt down this 1732 into the, or this 1735 into the 16, blah, 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 blah. So I wanted to add that tidbit in because my student had the 3-month chart marked off. Love, love, love. Um, Now, another thing too, because the student is following the 4 phases of the market, accumulation, uptrend, distribution, downtrend. Beautiful, 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 beautiful. That means that at all times you need to default because if that's what you use to anchor yourself for what this chart was doing, then at all times you default back to market structure. So what I mean by that is what we want to see is we want to see price consolidate at these lows. So I shouldn't expect it to just be a clean pickup because this person literally marked off, hey, it accumulated here at lows, uptrended, accumulated at highs, broke this range, did a bearish change of character right here. So we should see it accumulate at lows and then uptrend. So look how that helps set your expectations of, all right, don't expect any clarity in the next week. Probably not even next week. It needs to accumulate a little bit. Look how many weeks it consolidated here at the top, right? We're going to want to see this accumulate a little bit. So that sets expectations right there. And we got one more thing to look at on this beautiful chart. It's actually made me like really happy, really proud seeing this. Okay. And as y'all see, they already had, I didn't even mark off the daily fair value gap. The daily fair value gaps, dang. But again, that's just, this person is already ready for the areas that come above, or where the areas that are the areas of liquidity that sit above us. This person is already ready with those charts. Very much so already ready. And so I'm quite pleased. We're gonna drop down to the daily. And we just want to keep market structure in our sight here. Yeah, I'll keep that supply zone. And what I mean by that is that we got the lower low, a higher low. Now we're making this lower low. So again, the next move is what type of high are we gonna get? If this is gonna continue the bearish trend, which I feel I'm pretty sure this is gonna. I'm not Miss Cleo, but I just wouldn't be surprised. Go ahead and balance this out, okay? That was a historic run. Historic run from $8.50 to $33. And that was in between April to November. April, February, March, April, May, June, July, August, September, October, no, 7 months for this? What? A good rebalance is would not be surprised, okay? So my bias is that we gonna get this. Something like this. Maybe it doesn't go to the top, maybe it just goes it, but this is my bias. And then from here, this gives us, I'm not saying it's gonna go straight up, but I am saying like from here. I think from these lows at this 1480 is what gets us back here to where price was. Now, Another thing that they added in with their analysis is the projection, the forecast. Smart. My children are smart. So if we're looking at this forecast, the minimum projection is $12. Okay, yeah. We already looking saying, oh, this needs to balance itself out at 12.85. No problem. The maximum is 38. We're already saying that we expect for this to go ahead and do what it has to do down here on the monthly, which is still giving us a higher low. Go ahead and pick these orders up so you can go ahead and run. The least of our worries is just back to all-time high, which is at 33. This is telling us 38. Bet. With the average price being, ooh, what was that average? 25.56. 25, oh, sorry, 26.56 and 38. Let's put that on. What? 26.56. I'll delete this for now. I don't really need that weekly reversal. We're already so far below it. 26.56. And this is the average. And then our projection is at 38. Mm-mm. Nope, just 38. All right. I'm gonna love picking this up at 1480 in this 14 range and run this sucker up to 38. I'm going to love that. That's the path that I want to take. Will I take these movements here in between? Um, Well, I don't even want to word it like that. Would I sign off on anyone who wanted to trade these legs in between, the push swing trade, the push back up for the lower potential lower high, right? If the case is going to be that it's going to continue to drop down, if we go with the bearish case, would I suggest entering this pop back up to create the high? No, just because we don't know where the lower high would be. It very well could be at the bottom of this fair value gap. It could mitigate it. It could come to the top. For someone who's interested in being a swing trader due to time, I that's gonna require you to watch it, right? It's like, ooh, okay, if my alert goes off here at this 1892, did it really reject or is it gonna sweep those highs? Or same thing at the mitigation, same thing here at the top. I'd rather not. I would rather wait for it to confirm that it's going to make a lower high. So how can you do that without having to constantly watch it? What I would suggest doing is to have, obviously, we want to have our alert here at the bottom of this gap. So at the 1893, I'm going to double click on that. And for the conditions, what I'm going to say is I own, why does it keep changing that? We're going to add a condition in 1893. I don't know why I changed that. But we're gonna say I only want to know when price is crossing below it. Below it. Why is that? SOFI crossing below. Or actually we're gonna delete this condition. Yes. I only want to know when it's crossing below 1893. Now why? That's because I want to be prepared. Let's say that this happens. This goes ahead and closes above 1893. Let's say blah, 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 la, 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 things are happening. And it comes here and it ends up rejecting. Things are happening. I don't even know. Price comes back here. Now my alert is going to go off telling me that it went below 1892. So in my head, I'm going to say, wait, when I set this alert, price was below that fair value gap. Now my alert is going off telling me that it's trading below there. It must have ran the highs and created that lower high and given me this opportunity. Now, did I enter at the very top at the lower high? No, I didn't. Do I care? No, because I'm already knowing below 1892. I'm going to at least get this love down to 1735. At least. Let me take that. In full picture, right? Because how was your week? Not just Tuesday, somebody flipped you off and made you 5 minutes late for work. How was your week? Full picture. Maybe I didn't catch the very top of wherever the lower high was inside this fair value gap, but I know I'm finna catch this from 1893 down to at least 1735, highly probable to the 16, and we lose that highly probable to the 1480. It's the big picture. It's the big picture. You have nobody to brag to that you caught the very top at all. Big picture, due to like what you have time for. Okay. These alerts are everything. So me knowing this crossing down below there, that's the only time it's gonna go off, not just gonna send the alert every single time that price touches 1893, right? And make me think that, oh snap, I'm missing something because the alert keeps going off. No, I very specifically want to know when you're closing below here or closing below here. That's it. I don't need to know when you're going above it because I wouldn't suggest taking that move up. So closing below, and then of course we have the alert set at the like where our take profits would be, et cetera, et cetera. From there. But yes, I would definitely suggest catching the ride down into the monthly fair value gap. Um, Me personally, the student who's doing this, I'm gonna ask them to keep us all alerted because am I gonna take the trade? No, because my watch list is already full. I'm trading what I'm trading, but just creating monsters who can go in there and trade what they need to trade for their account and et cetera, et cetera. So this is an absolutely beautiful setup as far as like where all of our entries and everything would be, stop losses, the game plan and all that. So the last thing that we need to do is go to bar chart and we're going to go to SOFI. And what I'm doing is fee. Oh, let's go back because I actually saw something here. If it's still going to be on the screen. I hate that because it didn't. Let's see if I refresh it, if it'll be here. They had a free class sign that was here on the right-hand side when I first pulled this up. Darn. Tis not, but make sure that when y'all pull up, when y'all go to bar chart, sign up for those free classes that they do. It's very much so worth it, in my opinion. The voices are a little monotonous, but the information is free and good. Great, actually. All right, so far, the technicals are saying this is a strong sell with a strongest short-term outlook. Okay, bet. Even more so has me thinking we're gonna get that lower high so we can go ahead and run down to that fair value gap below us. Love that. What I'm gonna do is go to the expected move column first in the menu. The expected move, it's mathematical, not exact. It gives you a gauge, okay? The expected move, which is also referred to as implied move, reflects the price range that a stock is expected to move from the current price. It's calculated based on 85% of the value of the at the money straddle. So right now, SOFI is 18. So it's doing the calculation for like that 18 call and the 18 put at the same time doing that calculate whatever calculation they have, 85% of that value is the expected move, et cetera, et cetera. It's just a calculation. Is if you really want to know the calculation, write it in the comments or DM me. I'll give it to you, but it's not necessary for anything for you. But we are swing traders. We want at least a month of time. Today is the 23rd. We want at least a month. So we're gonna go to March 20 something, which gets us to the 320. This is telling us when we look at the 320 column that the expected upper price move is $20.28. The expected, if it moves to the upside, the expectation for the downside move is $15.96. Okay, bet. $15.96 by March 20th, which is really like right under here where we have our, like literally right there under where our first take profit would be for the downside, right? Like this is the yellow line is the expected move and then our take profit one right there. So, okay, bet. I like that. We looking in the same place. So I would not want to get a strike price outside of 16. 16 is in that range. Like 16 is the perfect number. If it's give or take one strike price, okay, bet, but let's go explore and see. So I'm going to click on this expiration date. We can do it right from here. We're going to click on the 320. And it brings up the option chain for this. This would be like if I went to the put call ratio and went that way, if some of y'all have seen me do that before. So we're not worried about calls. Not right now. We want to play out this put thing because it's just all the data is telling us that that's the highest probable move. That's our directional biases to the downside. If it flips on us, it flips on us. It is what it is. We'll trade it to the upside. We already have our magnets ready. We're prepared for that. But everything done told us, go ahead and get ready for this trade on down towards 14. But all right, so we want to know the 16 put. When I come here, it does not have the highest open interest. The 18 put has the highest open interest with 49,000, period. But the 16 put had the most contracts added. The OICHG is the open interest change. So 8,402 contracts were held at this 16 put. Mind you, we already had that number in mind before we even got to the resource. Keep that in mind. Before we even got to this resource, we already knew 1606 was the first place we was gonna take profit below 1735. Okay, bet. Bet, 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 bet. And it's currently 50 cents. Bet. Right here at this alert, well, we're gonna put them at both because we don't know. Are you gonna go ahead and go below 1735? Or are you gonna break above 1893 and then come back below, which is probable. So we're gonna put this at both. What's the message? SOFI, 16 put 320. And then we put that up there and we're going to put it here too, just in case it comes down below instead. All right. And we're ready to go. That's just that. And we're ready to go. That's the one that we're going to pick up. When it goes off, when that alert comes through on our phone, SOFI 16 put 320. And let me delete this yellow one. And yay, us, we're prepared. Now, matter of fact, what I do want to do is let's go ahead and plan out. Do I want to plan out the contract we would get? Why not? The leap we would get once it hits the bottom of that fair value gap. Now, a leap, it's just straight up. I'm gonna go the next year for the January. So January 2027. And we're looking at calls. And we know that it's projected to hit 38. So I'm going in that area first. And this is a lot of open interest. Keep in mind that for the 320 that we were just looking at, the open interest was around the same amount. If I go back to oh gosh, we go back to that 320 expiration date and we're looking at puts, we were sitting in that 49,000 range. 49, 20 to 49, 20 to 50,000, we'll say that. So if I go back to, and about the same here for the calls as well, which makes sense that we see some action to the upside. Look at this 20 call. Look at all the volume on here. And this is the 320 expiration date, that 20 call. Hopefully I don't throw y'all off by saying this. Keep in mind, what was the path that we expected? Yes, we want that push down. Overall, that's what we see, the overall big picture. But we also understand that this just made a very big lower low. It's gonna have to pop back up and give us that lower high. And the fact that the money is stacked at the 20 strike price, which coincides with the level of our monthly fair value gap here, bet, 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 bet. Now, if you are someone who can watch it, go into this monthly fair value gap and be prepared for the lower high. Do that. I'm not at all saying that you have to wait for this to come to go above and then break back below 1892. I'm showing you how you can make this work no matter what your work life situation is. You can make this work. You might not catch every single piece of it, but you can make it work. Whether you caught it here, or you just wait for this, you can make that work. Again, I do not suggest trading the inverse move, which is to say the pop back up, because we just don't know where. The orders are showing us that it's likely this 20 call, because that has the most volume and open interest. So around that 20 strike price is what the orders are showing us. But child, don't make this harder than it has to be. Keep this as simple as possible. But let's go back to the January 2017. I just wanted to look at how like, oh, look at the open interest for these calls is it's around the same. As far as the open interest, this between 20 and 20,000 and 50,000. So this how I know for sure. Like, oh, the institutions are y'all loving SoFi. Let's look even further. Let's see the next one that they, oh wow, this even goes to June 2028. Let's just look at the June 2027 because it only has January and then June and then December 2027 so far. So I just want to see what the open interest is for the June 2027. And it does decrease, of course. This is more so in between like 5,000 and 10,000. So I wouldn't, so this is I'm liking this January. And I didn't even look at the prices. The 40 call is probably what I'd be most interested in, either the 35 or 40, because my expectations is 38, right? That's the projected price. So I'd want to get between 35 and 40. And I like these prices and the open interest. But I'd probably go with the 40 call because it's the most affordable. Duh. If we went off just the numbers here, I mean the 35 call, of course, because it's a closer number than 40. And it's $1.24. I'm definitely gonna write this down. I'm probably gonna let me go ahead and add it as an alert here at the and I'm gonna do not quite at I'm gonna do it at the mitigation level of this one down here. Not that this is where I would enter, but because we don't know where it's gonna stop. But I do want to just go ahead and be ready for it and then compare the open interest. So I'm gonna do this 35 call one, well, 2027, and the open interest is currently 27,300. Well, 299. And this was on 223. So that I remember, like, hey, I said that this was the open interest on December. So if this is like, let's say that by the time this hits in here and this sucker is at like the open interest is at like 50,000, ciao. I'd probably just go ahead and buy it. I'd probably just go ahead and buy it. You don't expire till goddamn January of the following year. Like, okay, I got all type of protection in there. I probably would go ahead and buy it, but I'd wait to signal it till I knew for sure it was making that higher low. But that's if like the open interest had like doubled or something, right? I'd be like, well, shoot, me too. Me too. Mm. But so we have this one there. We're prepared for the lower high, and that is how I analyze out my swing trades. Chart my swing. What? That's how I make my game plan for my swing trades there. And hopefully this video and this lesson helped clear up a lot. I'll see y'all at the top.